If you're a limited company property investor and you've got properties valued at more than £500,000, make sure you watch this full video as there might be some tax compliance issues that your accountant's not told you about. So, ATED, it's that time of year again, the annual tax on enveloped dwellings. And if I had £1 for every time that somebody I spoke to didn't know about this, they completely missed it, then I probably wouldn't need to be posting these videos anymore. But here we are, it's a requirement, and if you miss this, even if you miss filing a nil return, there are some potential penalties that will come your way if HMRC ever catch up with you about this. So ATED, what is it? If you're a limited company and you own properties more than £500,000, so if it's valued at £500,000 back in 2022, or you've purchased it subsequently and it was for more than £500,000, you probably need to file a return. The return's filed online, and depending on the value of your property, there's a couple of different tiers that apply. I'm going to pop them there now. You can see that essentially for the value of the property, there's a tax to pay based on its value. And the reason for this tax is to stop all the wealthy individuals that were buying properties in London, or the Saudis and the Russians buying properties to essentially avoid tax. And it's a way of basically stopping people do that. But there are a number of reliefs that apply. Essentially, a lot of people watching this right now probably thought, oh, what? I didn't know about this. I've got more tax to pay. But there are exemptions that apply for probably 99% of people watching this. The first one is if you let the property out on a commercial basis, which will probably tick the box for most people here. You've got a property in there, it might be worth more than £500,000, but you rent it out. You're not living in it personally, your family aren't living in it, or you might be a property developer and it's held as stock. That's another exemption. There are quite a few more as well. I'm going to pop the link into the details just in case you fall into one of those small boxes. But for the vast majority of people, if you've got property over £500,000 and you let it out, or you're a developer, you still need to file a return, but you won't have to pay those taxes we just saw there. You've got until the 30th of April to file this return. And one question I had from a client just this week, we've got a multiple block of flats. We've got a multi-unit freehold block. It's got 8 flats on there, but not one of the properties, when you look at the individual dwellings, is worth more than the £500,000. Do I still need to pay it? In this case, the answer is no. It's annual tax on envelope dwellings. So you look at the single dwelling house on its own merit, and even if it's held on one single freehold block, because each individual dwelling is worth less than the £500,000, you won't need to file a return in that case. But for a lot of HMO investors, where you've got a large HMO, because you've got basically access to each of the individual units, by hallways, corridors, things like that, well, actually, a HMO is usually caught by ATED. So if you've got a HMO worth more than £500,000 or a single property, you will need to do a return, but as it's being commercially let, there won't be any tax payable. If you want help filing your ATED return, you can drop me an email, book a call with myself to run through how we can help you file this, or at the very least, make sure that your accountant is filing this for you, because if not, there are pretty nasty penalties for not filing this. So there we go, guys. Short and sweet this week. More to act as a reminder for everybody watching this channel that ATED, what is it? How does it work? And if you need to do one, make sure you get it done. See you next week.